we're in bubblicious territory, but I think we'll go up, we'll go down, and we'll come back faster than all the other previous cycles. Everything is compressed.
Hello, everyone, and welcome back to the Carta Data Minute podcast. I'm your host, Peter Walker, Head of Insights here at Carta. Today, I'm speaking with Ed Sim of Boldstart Ventures. You're probably already reading Ed Sim's newsletter, but if you haven't, his conception of inception round investing, whether that's a tiny pre-seed or things all the way up to what we would call a Series A, is I think one of the most unique views on how to invest as an early stage manager. So we spoke a ton about inception round investing, what it is and what it isn't, and of course how it's changed in this mode of AI that we're in at the moment. We also spoke about why these cash raises have to be so flexible and how no one really has a great handle on how much money startups actually need to grow these days in comparison to 18 months or heck, even 6 months ago. We spoke about the multiple ways to build a company. We spoke about the bifurcation of venture between small niche managers at the earliest stages and big multi-stage funds up at the upper levels. We spoke about founder and GP secondaries and tons of other topics. Ed is a fount of information. Let's jump into the conversation right now. This weekend has been this week, this relaunch of ChatGPT is such an interesting moment because I feel like every time one of these things happens, there's this spike of excitement and interest. And then it kind of we settle back down or we kind of forget about how much has changed. But then you look back over the last 2 years and it's like the whole world is already different. I don't know if you get that sense of everything's changing much quicker than it used to.
It is. For sure. I look, put it this way, I'm on year 29 as a VC investing in kind of first rounds of software companies. And even when the internet was started back in 95, 96, that Netscape moment, think about it. I thought the world was moving fast then, but people were still on dial-up. So the world wasn't even on the internet back then.
Right.
Then you had the mobile thing, right? And the mobile thing was the speeds were so slow. Okay.
Yeah.
Then you had the cloud thing, right? And then now you have this. And this, I feel like everything is happening. The cycles are so much faster. Everyone's online. We all have broadband access anywhere we go. Yeah. And the cycles of what you can ship, the software's better. It's easier to build stuff. It's easier. We have the cloud now. You can ship things fast. So everything is compressed and accelerated. And I think also it's going to be impactful in the way that bubbles happen too. So we can talk all about that later too. Because I feel like, we're in bubblicious territory, but I think we'll go up, we'll go down, and we'll come back faster than all the other previous cycles. Everything is compressed.
Did you read the Bubbles and the Power of Bubbles book from Stripe Press that was out recently?
I did not,
but it was making the positive case for bubbles.
Okay, yeah, and I've you look at kind of the Carlotta Perez kind of books on kind of cycles. You read about Tulip Mania and all those things, and bubbles, they are good things, right? And I think that it'll clear out kind of the grift. Because there always is grift when it comes to
and introduce new grift, perhaps. Yes,
exactly. But in the long run, we will be. I hopefully believe we'll be way better off as a society and with what we build, coming out of it than before.
So is AI a bubble?
I'd say in certain areas, yeah. I mean, look at the pricing. You're paying 100 times forward kind of revenue, for things that you may not know if it's recurring revenue or not. I definitely think so. I mean, it's so on the ZERP side, for example, we just lived through ZERP, which was an incredible bubble experience, right? And I think it's happening again at the same time. And the only difference I would say that this time though, is that, if you look at kind of the world moving forward, I do believe that when we come out of this, some of the companies that get created out of this are going to be way bigger than the companies that came in previous cycles, number one. Right. Number two is I think the spread between how many great companies there are to how many shitty companies there are is going to be even wider. and so I think, everyone's chasing that dream, right? And there's more money than ever right now being poured into the private industry. So you add all that up together and you turn that into a Molotov cocktail of stuff that creates a incredible environment to be building companies right now, but just buyer beware is all I can say.
Does that mean by default you would have less of a middle class of companies? Where you're either going to be really small or gigantic and we're kind of hollowing out the center?
Yeah, I think, look, everyone thinks that they're going to build a gigantic company, but not everyone will get there. But the gigantic companies will be more gigantic than the ones in the past. I mean, look at the size of the private companies now, even like an OpenAI raising at apparently at $300 billion.
Right.
So I think that's the opportunity that we're all chasing, right? That many people are chasing. But, I'll put it this way. Another way to look at it is zoom out. What are LPs or investors thinking that invest in venture capital funds? I think one of my LPs summed it up very well, that during the ZERP era, everyone looks pretty good. So the spread between top 10% and bottom 10% was like a dispersion band that was kind of like, this. But now in the new world, that the dispersion bands are going to get much, much wider. So the median is going to go down, but the dispersion of great and shitty is going to actually almost be like twice as big in the terms of the band. And I think that goes back to my earlier point that there'll be some amazing, amazing winners. Yeah. There'll be a lot of losers as well.
I have so many questions about what these are facing right now, but no, it's perfect. This is great. Let's do some like basic ones first though. Give me like a quick definition of what you think inception stage investing means, because that's a term that I think gets thrown around. I think popularized by you, but it has many different connotations. So what does Boldstart consider inception stage investing to be?
Yeah, so I almost view it as going back to basics, the way that Arthur Rock used to kind of build companies. He used to take kind of technical founders, spinning out of, larger companies, and starting new companies with taking some technology risk and funding teams. Yeah. Right. And that was really it. There's nothing really kind of there. The companies had to get incorporated. They had to get their first few people hired. And I think what happened was when we started Boldstart in 2010, seed was just getting started. I mean, the A round used to be the first round. Yeah. And then was seed. And then was pre-seed. And then it's like post-seed, pre-seed, seed, A. I mean, and people got confused. And if you're a founder and you're starting a company, whether you need $1 million or whether you need $20 million, you kind of need one place to go. I want to partner with someone who will back my vision, back my team, back my unique insights when I have nothing built, when I'm just getting started. So that means usually collaborating with founders well before they incorporate, helping them iterate in their ideas. And then also, you probably know who the first 5 or 6 hires are going to be, because if they don't, they're probably not worth their weight in gold. So who are your first 5 or 6 hires going to be? How do we help you pre-sell them to maybe reduce the risk that you're going to join a well-funded startup upon incorporation? Right. And then boom, you're off to the races. And I think that, if you're a third-time founder, you're not going to raise a pre-seed round. I mean, a pre-seed round denotes another layer of dilution, doesn't it? Pre-seed round means pre-seed seed. Why do I need that? A pre-seed round also denotes the fact that, it's a smaller round, maybe less than 2 million. Well, if you can raise 15 or 20, I don't need a pre-seed round. And the third thing, by the way, is that if you look at PitchBook data, it says the median age of a company that raises a pre-seed round is 1.2 years old. And the median age of a company that raises a seed round is 2.7 years old. So who is actually funding the people with ideas? That's what inception stage investing in. And it knows no limits in terms of size of round. It's just about the people getting started. And, hopefully we can do is accelerate the process of building by 6 or 12 months. Instead of starting a company and hiring people, then raising money, and going that process on day one, after you follow your 83B tax election, you have...
Which everyone should do, by the way.
Exactly. You have a fully funded company with your first 5 or 6 hires ready to go and just start shipping product. That's amazing, right? So that changes the game.
I love that. So then it begs the question, how do you find these technical spin-out founders before they're on everybody else's radar?
Yeah. So then I'll say that back in the day, not at the Rocks day, it was kind of people spinning out, but now it's just founders kind of leaving, starting companies. But really what we're going to do is capture people. I like to say that inception investing is about investing in people, not companies, right? Because you're helping them start the company. Look, I mean, I've been doing this for almost 3 decades. Boldstart's been at it for since 2010, so 15 years. So we have a whole network of people that know that if they want someone to lead and kind of have the conviction and courage to back them with nothing built, particularly in our domain, which is partnering with technical founders, building software, primarily in enterprise, then, we're the place to go. Secondly, I think what's important is that we're a pure play. Like if we're not in that very first round, we're not going to come in later, right? So I do think that we do have an ability to help founders kind of, see the forest. We can help them kind of accelerate some of the process of getting to product market fit. And then we can help them, I think, navigate the path to kind of raising that next round of funding, getting the first customers on board and doing all those things. So that's kind of all we do repeatedly. And so anyways, that's kind of how we find most of our folks.
And that's such a clear value prop. Does that mean then that you're not following on later stages, or is it just, you're just solely focused on picking and choosing at that very, very early moment?
So it's picking, the initial entry point is picking and choosing at that point in time. And then the goal would then be is like, I joke a lot about kind of Ricky Bobby Ricky Bobby's dad told him that if you're not first, you're last. And I keep saying that there's this whole movement in the industry on the race to be first. It's about getting pole position with partnering with the right founders, and actually, getting that influence early, getting on the cap table early, building that relationship early. So once these companies start accelerating and they raise their A rounds, we're definitely going to do a per round or more, B rounds per round or more. And so we like to say that we can do full lifecycle investment all the way through IPO. And we actually have an opportunity fund as well that's almost as big as our main fund. The last fund that we announced was a few years ago. We picked a very funny number. We wanted to be under $200 million. We picked 192.168.111, which is the IP address for routers, right? Type in that number in admin password. And then our op fund is 175. And so
why did you want to be under 200?
We just felt that was the right number for 4 partners at the time, based on round sizes and everything else, where we could build a portfolio of 25 or so core companies where we were on the board, and then also have like another 10 to 15 smaller shots on goal to have a portfolio of 35 to 40 kind of, we'll call it shots on goal, to kind of build the next big thing. And I can tell you about all the different ways we enter. It could be smaller checks, which I know you'll ask about later. It could be bigger checks, but there's got to be multiple ways that you win and multiple people you compete with depending on the check size itself, right? So fast forward, I'll give you a good example. Snyk is kind of the ones that we started backing in 2015. That was Guy Pajani's second company. We backed his first company, which ended up selling to Akamai. We were the very first check for his next company. Last year they announced that they crossed the $300 million ARR mark, building out a new platform for developer security, right? And it's expanded into more application security areas. But we've been in there from the very beginning. I'm still on the board. We continue writing checks through all the rounds, and we maintain double-digit ownership stakes through time, right? So that's kind of part of the game.
That is the game. I mean, that's the whole game there. Okay, so you mentioned the check size, like playing at both smaller check sizes where you're competing again against totally different people than $20 million checks. And you actually wrote about this pretty recently in your newsletter about the barbelling of these early rounds, where you're either raising almost nothing or you're raising quite a lot. Yeah. Do you have a preference on which deals you invest in, or how do you coach founders through their thinking on that?
Look, a lot of it's driven by founders, and the problem is that there's so much money in the market. And let me tell you I'll give you three types of inception rounds. We can talk through each one. Okay. I call one type of inception round the discovery round, which is, usually less than a $2 million round size. Could be a first-time founder. It could be an area like WASM, like two or 3 years ago, WebAssembly, kind of the WebAssembly space. That's so early that maybe you just don't need that much money. You just want to spin around with a couple engineers when you get started, right? Yep. You have on the far end, that's discovery. Then you have your classic round. That's usually 3 to 5 million in size. That almost is like your classic seed round, right? It's usually led by like $100 million seed round firm, et cetera. And then you have your jumbo round. It's like your $8 to $10 million round or greater, or up to 20, 25, 30. It could be even 100 million. I mean, we're not playing in that end of the spectrum. But I'm just saying, up for us, we've so far participated in rounds up to 25 million where we co-led. But the point is, on those your second or third time founders, they had prior exits, pretty good companies. Look, I don't want to have a portfolio full of those, but you have to answer the question, if you're actually an inception investor or seed round firm, do I want to continue backing up the Guy Bajarnis of the world after he's built a company that's worth 7.4 billion when he starts company number 3? And and the question is how big do I need to be to do that? If you have a $100 million fund, you're not going to be able to co-lead Guy's $25 million round for his new company, Tesla. Right. And so our conscious choice was, yes, we do believe that in the universe of companies that are started, there's 20, big winners, every couple of years. And you want to make sure you're in those and you have access to those special founders. By all means, you should be backing up the truck into those companies, right? So if when a guy started a new company to reimagine software development, he calls it AI native software development, and we are partnering on company number 3 with him, hell yeah, we're going to kind of co-lead that inception round. Right. And fast forward, he hired a team of 22 people in short order, and 6 months later, he raised another $100 million from Index and Excel to continue down that path, right? A 750 post that was reported in the paper. But, so those are the different kinds of rounds. You can imagine jumbo rounds. They're all multi-stage firms, right? All your big tried and true names. You don't have to name who they are, but you can imagine. Sure. And those discovery rounds, usually angels. And in between the 3 to 5 classic rounds, what happens is that either that's a pre-seed round that got bigger because the seed round saw and said, I need to write a bigger check and own more. Or it's a really interesting founder. Maybe they're first-time founders with pedigree from a firm that people, from a company that people really like backing. and that the multi-stage firms say, hey, instead of raising 3 or 4, I want to raise 8 to 10, and then get supersized. Yeah. And so that's kind of where the market kind of plays it, in that stratification. And I keep saying that the world is barbelling. Barbelling mean that they're either smaller rounds of less than 2 or rounds greater than 10, because I think in the AI world, there's a belief from some people that I want to raise as little money as possible with as little people as possible to get as big as possible. Yep. And I don't want to change the conception of those founders, kind of that's their, for sure. I'm not going to force you to take more money than you need, because you don't need that money, right? And there's no reason to. So for example, Crew AI, which is a leading kind of platform for building multi-agent teams, they started out with a $2 million round. And we wrote, like a $1.3 million check in that initial round. He didn't want more than 2. He had raised 5, 6, 7. And then fast forward, we ended up giving a little bit more money after he had some proof points. And then from the initial check to his Series A was 9 months later. Insight came in and led a sizable round. And now they're doing 2.5 million multi-agent crew runs a day right now. Wow. But do you think that founders get pushed into those bigger rounds a lot more than they should? Like, it's a multi-stage strategy to say, hey, we have more capital available to you. Absolutely. He was a sole founder. He's like, I don't even know what Ed and Elliot. I don't even, and Sean McGinnon, I don't even know what I'm going to do with 2 million. Right. Yeah. Just have it, hire some people. And then he ended up raising 4. We gave him more money, and then he ended up raising his A round. Yeah. And he still has plenty of money in the bank. But the point is that I think that a lot of times it's the tail wagging the dog. It is the VC telling the founder how much they should raise versus a founder saying, this is what I want to raise and this is how much, right? And I am more than happy to write smaller rounds. I really wish all the rounds were much smaller. But when a founder is getting thrown 50 to 75 million bucks at them and you're trying to get them to raise 20, in my mind, that's a much smaller round than the initial we're going to take. And I do think that necessity is the mother of all invention. So I do think there's a part where if you get too much money that you can also create problems. How do you decide as a founder how much you should raise? Because this is obviously such a crucial question, but it doesn't seem as though, especially in this moment where perhaps your need for a team of 10 is now a team of 3, et cetera, like with all this changing on the actual team composition side, how do you decide on that dollar figure? What's the right for you? Yeah, look, I frankly think that there's no right answer because there's so many different kinds of companies, so many different industries, right? For example, if you're creating a tiny little vertical software company, then maybe you don't need a lot of capital, and maybe if you're a lifestyle business, you just need 2 of you shipping product. Or on the other hand, if you decide to build, let's say, a new model with proprietary data for robotics, let's just say, well, guess what? Every one of the companies in that space is super, super capitalized. Yep. And in order for you to hire talent, right? For me, I think about it as like, what kind of talent do you need to build what you have in a very unique way? And if you're looking at specialization like that, you're going to need a bigger war chest to attract the talent that you need to build that. So I kind of varies from that perspective. And then finally, the last part is, look, if you're a first-time founder, it's probably harder in general. It's probably easier to raise smaller and prove it than if you're a second or third-time founder. I think it's more the second or third-time founders are the people in the margins. Let's say, for example, you could raise a $3 to $5 million round and you get an 8 to 10 throw. Yeah, that's the question you have to ask yourself is, what should I take? Yeah. And I think what ends up happening is that, and I'm not going to say this is the same case and everything, but you take 8 to 10, the pressure amps up, especially if you're a first-time founder of kind of what is expected of you and kind of what you need to do. And some people can handle it and some people can't, right? So I think you have to choose wisely and think about those things. Do you think that a lot of other, I don't know, I'm not sure that the emerging manager term covers a lot of people, but I have heard pretty consistency lately that there's a frustration from smaller emerging managers with multi-stage firms because they feel as A, they're getting priced out of deals they want to be in, and B, those deals are not actually in the end actually that beneficial to the founders. So like, how do you interact with multi-stage firms that way? Do you think that they are distorting the market? I would say that it depends because
sure.
I mean, look, I've partnered with many multi-stage firms. We split rounds. I just split a new security company with a very large multi-stage firm. We're all very happy about how we're working together. And I think, by the way, the firms, you can separate the firms from the people because I think there's definitely people that think differently, that are builders versus, investors, right? But I think the most important thing as a founder you need to think about is who understands kind of where I'm at in my cycle. And, the one thing that I can say is sometimes I see where you're a later stage investor trying to go earlier, you try to apply the same playbook or framework, which is I give you money, we scale as fast as possible. And where the real trick is, how do I spend as little money as possible to get to product market fit before I start stepping on the gas? Those are two different, very, very different phenomenon, which means sometimes you might try 3 different things and it doesn't work. Fourth time it works. But imagine if you're on iteration 2 and you're forced to raise and hire a whole bunch of salespeople to sell something that really isn't going to work. Guess what? You're going to run out of money very, very fast.
Right.
So I just think that, yeah, look, the rounds are getting, I mean, you see the data, right? I watch your data. You talk about like the 75th or 90th percentile. You're talking about $30 million valuations or $30 or $40 million valuations on the, you call it seed, I'll call it Inception.
It's wild. Yeah.
But yeah, that's a phenomenon of multi-stage firm having billions of dollars and just, writing these massive checks. And all I can tell you is that us as we'll call it an inception-stage firm that's more right-sized, I can't do $10 million deals. Right. I've got to pick and choose which 3 or 4 that we do and lead or co-lead in the $10, $15, $20 million round. So we may see 10 of them, but we may only do 1 of them. Right. If you know what I mean?
Yeah.
So I can just say for the one, I hope that's the one that is the right one that has the right amount of capital is my hope. But, as I said, I can't do 10 of those and not everyone's going to work out well.
So you wrote something recently in, how do you say the name of your newsletter? What's hot it.vc? Is that how you say it?
What's hot? Yeah, what's hot in IT? What's hot?
Because it's fun to read. When you read it, it's like there's a lot of eyes and teeth.
Yeah, well, at least what's hot in enterprise ITVC?
There we go. Love it. So you said something that I think I am hearing consistently from a lot of fund managers, which is there's kind of 2 worlds right now. How do I support the companies that I invested into pre the AI boom? And then also make sure that I'm involved in companies that may end up eating those older companies, or at least like competing with them really heavily that are AI native. It's like, how do you balance those 2 things within your own portfolio?
It is so funny, right? I've been at this a long time. We've got Superhuman. We funded. I'll give you a great story. So the Enterprise Tech 30 that came up from Wing, which have 100 different judges. I'm actually one of the judges. We had 3 companies that were part of the ET 30, and I shared that recently. Superhuman. That's not a fund 2. I think we funded that thing like 11 years ago.
Wow.
Play is not a fund 3. We funded that thing like 8 years ago in the Inception round. And then Crew AI is 2 years old. So I think there's the answer for you right there. I mean, when Superhuman was started by Rahul, there's no AI around. He just wanted to create superhuman powers just through these keyboard shortcuts. Now he's layered that on with AI. And now all of a sudden, here's this older company. And he's in ET30 company, which is kind of cool because you'd imagine that's reserved for the hottest, coolest startups kind of getting created now.
Definitely.
Clay is the same thing. I mean, when Clay was started, Kareem was set out to build a more programmable Airtable. And I like to joke that guess what? Airtable won because no one cared about a more programmable Airtable.
Right.
However, people kept saying, can you put all these data feeds in and everything else kind of into the platform? And then all of a sudden it became kind of this outbound mechanism. And then all of a sudden he's created this movement around GTM engineering, right? Kind of outbound, layered with AI across every step of the path. And now he's an ET30 company. And that company, by the way, which is really interesting, I think I shared the data, really did no revenue for the first 6 years and then went from 600K to 4.6 million to 30 million of ARR.
What were your conversations like with them during those first 6 years where they had no revenue? Like year 3, year 4, you're like, what is going on with this company?
No. So my partner, Elliot, he really worked very closely with Kareem and Nikolai, but now it's Kareem and Varun. And the smartest thing that those guys did, going back to my earlier point, is that they raised an early A round in the early days, like years ago, and like a $12 or $15 million A round from Sequoia. And you know what they did with that money? Nothing. They weren't ready at product market fit, so they kept tinkering and making the product better and better and better. My partner, Elliot, has amazing patience, but they kept shipping stuff. Right. They kept experimenting and trying things, and they're very communicative, saying, "This is what I'm going to try. Let me try this. Let me try that." And the only reason that they even are existing today is because they didn't go out, to my earlier point, say in iteration 3 or iteration 5, go out and hire a team of 15 to go sales and marketing for something that wasn't ready. Right. And then when they felt the product market fit, that's when they started amping up, and they still have a pretty small team. So I think that's the key. It goes back to my point. If you raise money too early and someone forces you to scale up prematurely, I think that is one of the number 1 causes of death, is to actually have a scale up company before product market fit. And you can feel product market fit. It's literally if I take this product away from you, I'm literally going to kill you, right?
Right. You're going to ruin your week. Right? Yeah.
And it's more of a pull than it is a push.
Yeah.
And then you're breaking at the seams. You feel like you're breaking at the seams. And so that's kind of, and the point is, I think that people talk about the stories of Cursor and all these other companies, but even Bolt, right? Wasn't Bolt around for 5 years, like 3 or 4 or 5 years before?
At least. Yep.
Yeah. So yeah, it's a great story, but there you go. The patience is needed. So these things come in all flavors, but when you hit it really big. So going back to my earlier point, I've seen companies like Clay stick around and, kind of wander around for a little bit, but ship and build. Superhuman. But now they've layered on AI. And so basically, if you're an incumbent, like let's just say if you're a 10-year-old company, if you're a Snyk, you're a big ID, or or a customer, right? We sold customer to Meta for over a reported $1 billion, but we bought it back out. We relaunched the thing with all agent workflows. So basically, what you have to do is basically say, look, either I'm going to embrace AI all in. What's my advantage? My advantage is I'm still young enough to ship product like crazy, but I'm old enough to have a data moat. All those companies that I mentioned have massive data moats, but you have to actually be very particular. You have to be very, this has to be driven by the CEO saying this AI stuff is super, super important to me. We need to ship, build, and leverage the moat. So that's the one hand. And the other hand, you look at new companies and you're like, oh my God, like this company could kill my other company overnight, right? So
right.
And so like you have to literally just shift your brain and say, okay, that's going to require more work. It does require more work for a bigger company to kind of get it going. However, because of the data mode, I think there's a massive advantage. And then you watch this new shiny little company, you wonder like, okay, you can ship things really fast, but how do you get sticky? Like, how do I know that your land is not a pilot that's going to actually go into more of a production environment? And then how do I know once you're in the production environment, you become sticky? How do you go from becoming this assistant to becoming part of a bigger workflow? Once you're part of a bigger workflow, you get harder to get ripped out, right? So those are the things that you have to think about when you're looking at kind of this world of AI.
You touched the durability of the revenue from these AI companies. I think it's kind of the topic du jour. Do you have an instinct? And it kind of feels to me odd, right? Because we're 2 to 3 years into the AI boom. We're not 1 year in. So there should have been one annual cycle of renewals. I mean, obviously there are younger companies than that and they're just starting now. But like before that annual moment of renewals where you get some actual signal, how do you judge the durability of this AI revenue for a lot of your younger bets?
Yeah, I mean, look, it's hard right now because even the companies I mentioned, I mean, how old is Cursor right now? And some of the other things, right? Less than a year old.
A year or two, a year and a half. Yeah.
Yeah. So I think you have to take a best guess, meaning that one is you have to understand the usage. Is the usage going up or going down every single day? How often are people coming back? What does the expansion look like in some of your best performing kind of look? At the end of the day, if you're a PLG company, not everyone's a lot of people are experimenting with things, know.
Yep.
Come out, but you got to look at that. Look at the usage, look at the expansion of teams, look at kind of the enterprise kind of rollout around that. Because once you get to the enterprise, I think it becomes much stickier on the contracts, et cetera. I think secondly is you have to think about like, what else is this company doing that can actually be more durable, right? For example, people have been hot swap out of, I know a lot of engineers that use Cursor and Windsurf from Codium and other tools all at the same time, right? And so like, what is the substitution cost for some of these things? And if the substitution cost is very low and it's easy and it's a lower friction kind of turn off of something, then what is that company doing to get deeper into the workflow, to get embedded even more? Because the more things that you can do in a workflow, the harder it is to rip out, right? So if there's 10 steps of the workflow, you're 4 steps to that versus 1, well, you have a much better chance. So those are all things that you need to think about as well. But once again, it's too early. Ultimately, the number is going to tell. It's very early right now, but people are making some big bets around kind of what the future looks like for sure.
Very big bets. Do you think pricing and packaging also plays a role in that? I mean, the basic stuff like monthly versus annual contracts, but even more on the usage pricing, et cetera.
I mean, it does, but at the end of the day, it comes down to, are you creating a killer product that people absolutely love? And, I think someone once mentioned that, I think maybe the Cursor guys said that my job is to obviously my product every 12 months. So, I think this goes back to like moats and durability. I think durability also goes back to moats. And, the question is what are moats in AI? I mean, look, I think there are very few moats in software in general. I like to say that with time and money, you can always copy something. I don't know whether it's 6 months, 12 months, or 18 months, but there's very little moats. And the question again is, what are other moats? Well, speed, right? So to the point that Cursor says, if I obsolete myself, vision in terms of what direction you're going, in terms of the speed at which you right? Kind of what are you building versus someone else? Like you may be going in this direction, someone might be going that direction. I also think about like network effects and community and other things like that, right? So word of mouth, right? Kind of how are you doing your marketing? So I'll give you a good example, Clay. Is Clay an AI company or not? I don't know. I mean, it didn't start as an AI company. I think everything is really an AI company at the end of the day, right? If you're not using AI, it doesn't really matter. So I don't know how you characterize it. How do you characterize what an AI company is versus isn't? Because I'm curious more than anything else.
I get this question all the time, and then I give back what I think is a terrible answer, which is we asked the founders, and they told us, and it turns out when you do the valuations according to that definition, investors kind of agree. Look, there's no real answer because are you building a foundational model? Are you fine tuning a model? Are you simply implementing AI into your own workflows? All of those count, and to your point, the defensibility is different depending on who you ask.
Yeah, but like I think there's a big data defensibility, right? Like I almost think about the flywheel from a ChatGPT because it's such a consumer phenomenon. Think about every query that it gets.
Yeah.
Every answer, every thumbs up, all the data that it creates and the learnings about how good or how bad, that reinforcement type learning, I think is super, super powerful. And that's more data. What does that do? It creates more good data.
Right.
And I think data, I definitely think is a moat over time because, there's a lot, in my opinion, there's probably 9% of the data that's so dark that's not used right now. Dark meaning that they're sitting behind the firewalls of a large enterprise.
Right.
And I keep asking myself, like, how do you kind of unlock some of that? And
do you think that, is the data proprietary question part of your evaluation process for these inception rounds? As in, I'm assuming that most of these companies, given that they're not even companies yet, don't have a moat of proprietary data, but are you looking for a clear path where they could build one?
I like to think to myself that over time, like maybe from usage or whatever, that they do think about that, right?
Yeah.
Right. That they're going to create a flywheel in which they can get some data, right? And we all know foundational models at the end of the day. I mean, their advantage is 3, 6, 9 months, maybe max, before another new model comes out. And so then it's what's the data around it, and that to me is definitely something important that we like to ask. And look, we've done some stuff that I would call it on the edges of enterprise software. We'll call it software disrupting industries, but we haven't announced an investment that we made about a year ago into a team out of Google DeepMind and Boston Dynamics, creating a new kind of model around robotic hand dexterity with a proprietary data mechanism. We also funded a friend of mine from college and some of his buddies that were creating a new model for proteins. And we'll say from proteins that AlphaFold is not covering, we'll call them more dynamic proteins that are harder to model. And there's a data moat around that, which required some lab work. So, when you go down those paths in those very particular areas, there better be a very specific knowledge base of how you're going to get the data, what you're going to do. And you can hear from both those teams. They had proprietary backgrounds around that, and everything else, in my opinion, is either building on top of, you got to ask yourself the question, every time a new model is released, are you getting better or are you worried about being extinct? Right. And I would hope that the answer most of the time is that you're getting better versus being extinct.
You should welcome the new model because it makes you work better as opposed to being scared of it. Yeah, no doubt. All right, maybe it's a good moment to pivot. You had mentioned earlier that you'd been talking to LPs of your own, and I read on your blog recently, you'd had a bunch of little bullets on what LPs and GPs are talking about today. What is the biggest discussion around your fellow emerging managers, your fellow LPs around venture right now?
Yeah, I'd say I always say the bifurcation of venture. It's the first big question. I like to say that we're hitting a world right now where this is a real industry. And
when do you think we hit that? Is it just starting now, or has it been like slowly professionalized over the
last 5 years? The size of funds, by the way, just look at the size of the largest funds and how big they're getting, and how big the assets under management are getting. And then even look at General Catalyst. They all have wealth management firms now. Andreessen's a wealth management firm. I mean, like,
Andreessen's going to be a private equity firm soon. Like, yep.
Is that venture capital? Which is going back to the Arthur Rock definition of finding a couple folks, starting a new company with no product built, with not even a slide deck, and kind of partnering? I would say parts of their stack would be, but they're not writing big checks there. They have massive machines that they need to kind of, make happy. Yeah. So I think there's this belief in the industry that either you go big like that, you go niche, and niche meaning that it doesn't mean small, it means specialize in some type of area, whether it be a specific sector, a specific stage, both, or you go home, and that's it. And I think there's an acknowledgement from a lot of these larger institutions, the LPs deploying capital. And look, you always want to be in the multi-stage firms, because if you're managing hundreds of billions of dollars, it's going to be very hard to deploy $100 million into a $100 million fund or a $250 million fund. So they're always going to deploy in those places. They have to.
Yep.
But there is an acknowledgement that, hey, and this is for the emerging managers out there, but there's an acknowledgement that they're not getting as much early stage exposure as they want. So for example, every dollar I put into a multi-stage firm, maybe 10 cents goes into like in 5 cents, maybe 10 cents goes into like the super earlier stages, and the other 90 cents goes elsewhere, or maybe some other bucket of funds. But if you come to a fund like us, you're at least getting every 50% or 50 cents on every dollar in that first check.
Yep.
And so if you believe that and you want that exposure, then you're going to look at more of us, which is why you're also seeing spin outs of lots of these larger firms. There's a lot of partners. Some are leaving because they want to leave and want to capture this kind of moment of opportunity, raise a $200 to $300 million fund and kind of be first one in and do all that stuff. And there's others that may be gently forced out as well. It's hard to tell what's what. Right. But the point is that there's an appetite from LPs to fund those things, and they want to get early stage exposure. So that's a good sign for everyone. The flip side is that there's zero liquidity right now. I mean, very little liquidity. Thank God for Google and the Wiz. Like, we're all cheering that on. That's fantastic.
We need at least a couple more of those. Yes.
Right. We need a few more of those, but there's not a lot of liquidity right now. And so people are making hard decisions at the same time, saying, hey, I've got existing managers. I have to call them back. I have to call back the managers I had from before versus adding on to them right now. So there's this kind of duality in the market. And then the final part would be, there's this AI wave that's happening right now. How do I capture some of that? So you add all those three things up together, and it's a very interesting recipe, right? And it's all kind of dependent on who the people are, who the firms are, and their strategies in terms of getting capital. And no one has a real answer right now, but the only thing that people do believe is that the dispersion between great and worst is going to spread maybe 2 to 3 times, and be 2 to 3 times wider, that dispersion, than it was during ZERP, because everyone looked kind of good during that time.
Yeah. Do you think this is a question that keeps coming up? And I don't know how I feel about it. I think in some ways it's pretty silly, but it's the common refrain of, oh, look at these returns from VC as an asset class. It didn't even beat the S&P. Like the median VC fund didn't even quote unquote beat the S&P. How do you feel when people are comparing public market returns to asset classes like venture?
Yeah, the only thing that I'll say is that the median, if you're investing in the median in VC, then you shouldn't be investing in VC.
Right.
Like if you look at every point in time in history, if you look at the top 5% or the top 10% maybe as a cutoff, then the idea is, if I'm writing a check into venture, that I'm hoping to get the top 5 or 10%. Maybe I won't get it. Maybe I get the median. So if I get the median, maybe it's not terrible, but it's not fantastic. But in exchange for the opportunity to get the next, capture that 5 to 10%, that's why you invest in venture, because those returns are so much better than they are which you'll get in the public market. And of course, as you mentioned, they're hard to deliver, right? And probably get even harder to deliver moving forward right now, because there's just so many companies. Multiple compression is down on the one hand for anything non-AI. Then, the AI bubble is here in terms of people pricing deals at 75 to 100 times. Some of them may work and many won't. And so that dispersion, once again, be pretty wide of success.
On the liquidity point, are people in your world talking about we've heard this word, manufactured liquidity, or like kind of pushing for earlier secondaries or earlier sales than would maybe be naturally useful for the founders? Do you hear a lot of that, or is that kind of just a red herring?
People are talking about more than I've ever seen in my 29 years of doing this.
Okay.
And if you ask me, like, people say, hey, like, could you have gotten some liquidity out, during the height of ZERP, maybe a little bit more? Yeah, we probably could have, right? A lot of people would have. But at the time when you looked at the multiples of everything else, like they were kind of going to the moon, right? So like, and that was going to last. So like, it's easy to say looking back. But yeah, I think people are having more conversations now than ever before about perhaps maybe at the B round or C round is maybe getting a little bit out kind of along the way. Moving forward. And at one point in time, it used to be poo-pooed from the founders and also other investors coming in. But I think people are more understanding these days because of the world that we live in.
I was going to ask if that affects the founder relationship.
No, I mean, if you actually look, if you're a small investor and on the board, then it probably doesn't really matter. In some cases, you might be doing the founder a favor. If they have a higher company and an oversubscribed round, you're creating room without dilution. If you're on the board and you're actively involved, then and you try to do that, then yeah, you better have conversations years in advance about that. It's like, hey, when you get to a certain point, just want to let you know this may happen because of my business model and everything else.
Right.
So I think it's having that open dialogue, but because people are talking about it now, it's written about in the paper and everything else, I think it's more of an open conversation where people are okay having it. It's not about you. It's not about not believing in you. It's that, hey, I still have a job to do that my investors kind of want me to return capital.
Right. And the secondary route, what's the, when we've looked at it, so much of the secondary volume is concentrated in 8 names, 10 names, et cetera. So secondaries feels to me as though it's being spoken about far more often, but it's not an actual reality for the vast majority of companies because it's not a supply side problem, it's a demand side problem.
Yeah, I think secondaries actually are only available in the hottest of companies. So you may not even read about some of these ones that are raising, $1 billion, $2 billion, $3 billion, or maybe the rounds are $100 million. I like to tell founders that, if people want secondaries, make sure that for $100 million of raise, get $200 million of demand. And then you take $100 million and you can figure out, hey, if there's some people that want out and maybe that we've got other new investors wanting to come in, that's the best way to do it. But you can't manufacture it saying that you're trying to raise $20 million and then and you only get 15 million of interest. You're still trying to sell 10 million secondary, right? It's got to be only in the hottest things. And that's also the question where you say, hey, do it take some on bait out and the hottest things kind of coming when you see kind of the world coming? It's a very interesting discussion. But if you're not cared about, then it's hard to get secondary at all.
Totally. What do you think about founders taking money off the table? Because it was a thing in 21 where we saw it happening in Series A rounds. Like it was kind of all over the place. And I think that world has retreated somewhat, but I still think it's kind of an ongoing conversation.
Yeah, I don't think there's an either or. Like, frankly, I love the idea of founders taking some secondary because it helps de-risk some of their lives and helps them go longer.
Yeah.
And the question, of course, is how much, right? And how much do they earn afterwards? So there's an ongoing discussion, but I don't mind founders like it to be around, getting some money off the table. They're not getting paid a lot. Maybe they, it depends on personal circumstance. Maybe they need to buy a house, about to have a baby, and they can make them sleep at night better. I mean, these are all personal circumstances. And if you're a hot company, you've got the demand and you can sell some of it and you can sleep better at night. But then also when that opportunity where someone offers you 1.5 times the last price of the last round to buy the company 6 months later, perhaps you might be like, you know what? I don't need to do it. I got a little secondary in my back pocket. I think it aligns people. However, if you're selling $100 million of secondary, you're only raising 20 the next round. So it really depends. But I am a fan of founders getting secondary as they move along. And I just watch that it de-risks them, it frees them up, it allows them to think bigger.
Yeah.
And I think that's an important discussion that everyone should have and just be open to doing that.
Well said, man. I think it's a weird stigma to me. Obviously, you can go too far with it, but the stigma attached to it for so long always didn't make that.
I'm so glad you're asking me this because there's so many things that you can say that there's no 100% clear answer, but it's always based on personal circumstances. But I always help, and I buy some of the secondary from founders. I help them get secondary.
Yeah,
I'm a fan of it because most of the founders that I know that even want secondary, there's a very specific reason why, and it's not that much after taxes, to be honest.
Right.
The amount of effort and time and work they put in, and they look at me now like, you know what? I want this because I want to go really big, and I feel, let me do it.
Speaking of trickier conversation with the founders, given where you invest, are you seeing founders starting to elongate their own vesting schedules past the standard 4-year, 5-year?
We haven't seen that yet. Haven't had that discussion, but it always is an interesting discussion that when you talk about like multiple founders kind of in a company together, what does vesting look like and all the things, because you like to tell each other, hey, look, this is a company thing, it's not an investor thing, but if one of the 3 of you leaves, like after 6 months, how do you feel about them and what do you feel about their vesting? Because I know that in a perfect world, your stuff was all fully vested, but how would you feel if you were doing all the work? So those are some of the conversations you help guide the founders. And those are things that they need to think about, kind of move down the path. As far as how long they vest, I hadn't broached the 5 or 6 year thing, but there are certain times where we meet founders and they'll say like, hey, I've been working at this. I've been funded just in my spare time for 6 months. I want to get credit for my 6 months of vesting. So I only want 3.5 years of vesting. And the one thing I will tell them is like, hey, look, let me give you an example. You go out and let's just say you build your product and 2 years later, you go and raise your A round. Guess what they're going to want to do if you're 2.5 years vested? They're going to revest you.
Revest that thing. Totally.
I was like, yeah, exactly. So I'm like, why even bother with the 6 months? Just just vest now. I mean, we give me 3 months credit. I'll give you 3 months of credit, but
Right.
I'm just telling you right now, I don't want to get you in a position where you have to reinvest 3/4 of it again.
You're not going to avoid that conversation down the line. It's coming, right?
So exactly. So like having some of those moments, I think is really important. And once again, it's just being honest and just having that conversation. And 99% of the time, like, oh yeah, wow, you're doing me a favor.
Yeah. I have like 2 or 3 more questions before we do one lightning round.
This is so much fun, by the way.
I know, man. I love it. Do we have too many? You can say pass. Do we have too many venture capitalists?
Well, I'll give you a 30,000-foot answer. There's a 30,000-foot answer is that probably founders would say there aren't enough because there's a lot of founders still not getting funded or seed.
Sure.
Right. So, and secondly, I would say that perhaps there's not enough because, anyone can start a company now and anyone can raise capital and whatever. On the flip side, I've been in the industry for almost 30 years now. Next year will be year 30.
Nice.
There's been an explosion of people out there. And my answer would be there's probably too many folks out there giving VCs perhaps a bad name, maybe and there's just too much money floating around out there right now. The valuations are absolutely insane. And so, I do think that there will be some compression in the industry. It always takes a long time. There's a long tail around it. And I think in the end, whether it's companies or firms, I think we'll be better off for it, in terms of building ahead.
Is the proper response to a wild valuation market like the one we're in now to deploy more slowly?
I just think, look, it's kind of funny. You kind of get what you pay for sometimes, right?
Sure.
Like, I'll give you because look at the Wiz. I mean, if you look at Wiz, 32 billion. I think if you do the math, like that initial $10 million round they did was probably at like $100 million valuation. Would you say that's rich or poor on that round? And the investors made an absolute fortune on that.
Right.
So you kind of get. So I think valuation is all dependent in the mind of who it is, what they're building, what the opportunity is, right? So I would say that sometimes you pay up for things and you get the value out. Sometimes you pay up for things you don't. So
right. Yeah.
I don't want to be one of those guys that complains about valuation, but I do think on the margin, there are things that are getting priced that are so high that should not be. And there's some things maybe that should be priced high and rightly so, right?
Yeah. Yeah. It just comes down to conviction at the end of the day.
Yeah.
And then
look, it comes down to the people, right? And to that point, as I mentioned earlier, like there are founders out there that could raise 15, maybe they decide to raise 20 instead.
Yep.
And God bless those founders, right? Because it definitely helps, right?
Yeah.
And by the way, what's the trade-off? The trade-off is, that perhaps they can achieve just as much with 20 and then they can raise 150 instead of 100 overall, right? And end up in a better place from a dilution perspective, a little bit farther down the line than having all the money up front when they don't even need it, right? Why don't I take all that dilution now versus later? So I think there's a balance between the two.
Yeah, definitely. All right, my 2 lightning round questions for you. First one, what is one space or sector or idea that is just fascinating to you right now? Since you invest across so many different kinds of businesses.
Man, God, you know what? I think right now, I was mentioning that I keep thinking about how models are going to be applied to different industries. So I mentioned that bio thing that we did.
Right.
I think it's just fascinating to be able to take combinations of models, fresh data, maybe out of the lab, and then also other things like molecular dynamics and leverage the power of GPUs, which are only getting better and better. And like this thing could not have existed 3 or 4 years ago.
Right.
And now we have something here that perhaps could cure neurodegenerative diseases like Parkinson's or things like that if done correctly. Hey, it may not work, but if done correctly, but who would have thought 5, 7, 10 years ago you could build something like this? Right. So I keep thinking on the margin, kind of what can you build that today that couldn't have existed 2 years ago? What do you build 2 years from now that couldn't exist, today, right? So I just think there's so much opportunity ahead, and I don't know what that's going to look like, but I just want amazing technical founders coming in and trying to blow my mind about what they're building.
Love it. All right, last question is, what's an example of something that you or another venture capitalist that has done to support a founder that's kind of unique or different or, beyond just, hey, here's a check?
Interesting. I mean, there's so much that's unique.
If you don't want to give away proprietary secrets, I understand, but
Well, I did have to sit down with one founder's spouse to convince said founder to perhaps not sell the company too early, and say like, look, I will help you get some secondary in the upcoming round that we are doing. And if we got, X dollars of secondary, would that satisfy some of the needs to relieve the pressure valve a bit so that you can go longer? And said spouse is like, wow, can you do that? Like, yeah. I was like, yeah. So just trying to figure out ways to, it goes beyond, look, starting a company is a really personal, hard journey. And I like to say that you're either better off starting a company completely alone without a partner, or if you have a partner, that partner is part of your journey and better be your best cheerleader. So I think sometimes in these situations where founders, perhaps maybe I thought they're going to sell too early, and that founder said, can you spend some time with my spouse? And that was a situation where it worked out for everyone.
Amazing. Right? Yeah, founders are people too.
Yeah, so those are some of the more personal things. I mean, we do a lot of things, right? I mean, those are some of the more personal things that you do in order to help perhaps generate, more returns for everyone.
Totally. Man, this has been such a fun conversation, Ed. Thank you so much for taking the time, man.
Absolutely. So much fun.
This is absolutely fantastic.